Yes, it was clearly a shock to most people. The pollsters, the bookmakers, financial markets all fully expected us to stay in, and it looked as if we would. I think perhaps what we all missed and the political establishment missed was, call it what you will, a rise of populism, anti-austerity, anti-globalization. Many people who'd not benefited from this great trend in recent decades towards globalization, putting up their arms and saying enough's enough. I think very importantly, the whole immigration issue was not taken sufficiently seriously, not just here in the UK, but by the rest of the EU. That was a major issue. But at the end of the day, the vote was clear. There was a very large turnout, 72%, over 1 million excess votes in favour of coming out. So the result is indisputable. And the bottom line is, Brexit is Brexit. We will be coming out. There is no going back. There's no second referendum. In due course, the UK will be out of the EU. But we've got 2 or 3 years of uncertainty to get through. And that's the thing. It's the uncertainty which is the problem in investors' minds. We don't know the outcome. It's conjecture at the moment. The negotiations haven't even started. Uncertainty means loss of confidence. It means reduced investment spending, probably reduced consumer spending. So over the next couple of years, there's no doubt that UK growth will be materially lower than it would have been had we voted to stay in over those next couple of years, possibly by 1% per annum or even more. So it's a significant impact to growth in the next couple of years. Longer term, it's an entirely different story. We have clearly 2 or 3 difficult years to get through. But longer term, I think there's a very powerful case for saying that the UK trading freely with the EU still, albeit with some constraints, but with a much more global, open reach, freed up of the bureaucracy, the regulations of the EU, able to make its own laws that best suit its dynamic economy. It could easily become, as it already is, the most sort of free market economy. It could easily become the most open, dynamic, innovative economy in Europe. It could match what goes on in the US, and I think it could be an extremely good place for inward investment in the longer term. So I'm not in any way concerned about the long-term future of the UK. Probably not as bad as the worst predictions of the doomsters. Markets reacted negatively instantly because it was a shock, but interestingly, the FTSE 100, the main index of large companies in the UK, is higher today than it was before the referendum. Now that's partly because there's a lot of international companies in the FTSE 100. The damage to markets has been in the areas one would most expect. First of all, the currency. The UK runs a very substantial current account deficit, over 5% of GDP. So sterling was always going to be vulnerable to an event which would be a potential shock to trade and inward investment flows. So sterling has taken the brunt of this. It's down about 14% against the dollar, a little bit less against the euro, more against the yen. So a very big fall indeed. Those stocks most exposed to the UK domestic economy, particularly things like house builders, construction stocks, they've taken a big fall. The other area of markets that's taken a big fall is financial stocks in the UK, but across the EU as well. Because one of the implications of Brexit is that interest rates in the UK are going to come down. The Bank of England has made that pretty clear. They're only 0.5% at the moment. They're probably going to go to naught. Monetary policy in the EU, with the ECB already with a very loose policy, it's going to be looser for longer. The Fed is very unlikely now to raise interest rates this year, probably not even next year. The other big thing that happened is that yields on government bonds fell sharply immediately post-Brexit and have stayed down. For instance, in the UK, the 10-year government bond yield has fallen by 60 basis points from roughly 1.4% to below 0.8%. We've never seen anything like this before. In the US, the 10-year yield has fallen by 40 basis points to new all-time lows, 1.3%. In Germany, they've fallen into negative territory. Big falls. Now, that has important implications for banks and insurance companies. So they've been badly affected by this. It comes at a time, incidentally, when the EU, the Eurozone in particular, is still wrestling with weak bank balance sheets pretty much across the Eurozone, but particularly in Italy. So that's added up to sharp falls in share prices of banks, and that raises the small risk of a credit crunch because banks will find it difficult to raise money. It's unlikely. This is not a financial event like the Lehman's event of 2008. It's not a financially systemic problem, but there is that sort of small risk that things could deteriorate further in the banking system in the Eurozone. Not in the UK, where the banks are very well capitalised. Indeed, I don't see it as a financial problem at all in the UK. It's more a political problem and a cyclical slowdown in the economy. But those were the really big moves which have been sustained since the Brexit vote. Markets globally have come under some pressure, but as I said, it's not a globally systemic event in my view, and I think that, to me, that's sort of like a risk-off period such as we've experienced on several occasions through the last several years. And I think in due course we'll recover from that. More volatility because there's much greater uncertainty arising from this, but it's not an event which is going to push markets dramatically lower from here. Well, opportunities will arise in this thing. The biggest concern I've got is that we have an extended period of uncertainty, and investors don't like uncertainty. It definitely weakens confidence and inward inflows. So this could go on for a couple of years until there's much greater clarity about the UK's future trading arrangements with the EU and its future relationship with the EU in general. In the meantime, you're going to get volatility and you're going to get these moves such as we've seen in the past 10 days. Markets fall pretty significantly. I would suggest that in due course, there's going to be some opportunities to invest in UK equities. If you're a dollar investor investing into the UK, then equities here are much cheaper anyway because of the currency fall, let alone the fall that's happened in stock markets. As I said earlier, longer term, the UK economy is going to be fine. So I think getting exposure to UK stocks in this period is actually a pretty good time. And if we do see further falls across stock markets globally, that again is a time to add some risk in equities. I wouldn't be attracted into government bonds. The yields are simply too low. They provide no protection against some sort of pickup in inflation. And incidentally, I think one of the outcomes of this vote here in the UK is that fiscal austerity will take a little bit of a backseat. We're going to see more pump priming, more fiscal spending by the government, spending on infrastructure. For goodness sake, they can borrow money at virtually zero interest rates. So I'm sure we're going to see more of that in the UK and indeed in due course elsewhere. So I think there will be some stimulus. We're going to have very loose monetary policy for a long, long time ahead. So if we see stock prices generally coming down, I think that's an opportunity to add risk, and definitely opportunities emerging in the UK. Periods of downside volatility, use that to add to positions. Look, we need in the UK here to get through this period of a political vacuum. We effectively have no Prime Minister in the sense that our Prime Minister has resigned. We're waiting for a new leader to be appointed. Nothing's happening. We need then to get on with the negotiations with the EU. We need to see some progress in that. So we're going to be monitoring that extremely carefully. We'll be looking out for the data very carefully in coming weeks and months about the extent to which the UK is slowing down, the hit to confidence that we've seen as a result of this vote. We'll be watching very carefully what happens across the EU more widely, what happens to the banking system in Italy, which is under real stress and needs recapitalising, what happens to the other anti-EU parties that we know are quite powerful in countries like France, Netherlands, Spain, Austria, what happens there. The bigger risk is that there's a breakup of the EU. Extremely low risk, incidentally. The political will behind the whole EU project is enormous, but it's not a zero risk. And the Brexit vote is a wake-up call to the European political elite. We'll be watching that very carefully. We don't think it's a global systemic problem, so we're not too worried about what happens in the Far East, emerging markets, the US. So our eyes are all very much, at the moment, on the UK, the negotiations with the EU, and how the EU handles this very difficult period.